Greetings everyone. Let us continue to the capital gain tax. We have already discussed the capital gain short-term and long-term capital assets. We have already discussed in the previous sessions about the full value of consideration. Moving further to understand what is cost of acquisition and how they are taken into consideration, let us move on further with the topic. To begin with, we'll first go with a small practical question or example, and then we will move on to understand the COA in detail today. So let us start. So here we have one illustration before us, which I'm going to read out first, and then we will solve it together. It says that Jojo purchased a house property on 1st September 1999 for rupees 4,10,000 in 1999. The fair market value of this property on 1st April 2001 was rupees 3,70,000. He incurred the following expenses. First point is construction of a room on the ground floor during 2000 to 2001, 2001, that is rupees 10,000. Then renewal or reconstruction in 2013-14, that is after 13 years, he renewed the house spending rupees 4,40,000. The property was transferred on 31st March 2025 for rupees 45 lakhs. Compute the capital gain. And we have to compute the capital gain, and the indexed figures are given, that is CII for the years are as follows. 13-14 is 220, and 24-25 it is 363. I think for 2024-25 now you must have learnt it, that it is always 363. So let us solve it together to understand things in a better way. Okay, so to begin with, first we will be just computing the capital gain for the assessment year 25-26. Okay, here we have under this first, obviously, what is your FVC, or maybe let us put that in the data, check it out in the data. It says that the property was purchased or acquired on 1st September 1999 for rupees 4,10,000, and the fair market value of this property on 1st April 2001 was 3,70,000. See, students, understand here that the fair market value here given for 2001 is important, because in when any property is purchased before 2001, because 2001 is the base year. So if any property is purchased before that, we always compare the figures. That is the FMV and the purchase price, and whatever is higher will be taken up as the I should say cost of acquisition, whichever is higher. So in this case, when we compare these two figures, it is very important to remember this. When we compare these figures, it is 4,10,000 that is to be taken into consideration. So we will go with 4,10,000. So, but first I'll be putting the FVC. How much is the FVC? It is the property was transferred on 31st March 2024 for rupees 45 lakh. So here FVC is rupees 45. Okay, 45 lakh. After that, we will now consider the cost of acquisition. So COA will be rupees, as we already discussed, 4,10,000. Okay, it is 4,10,000. After this, we have other expenditures also. That is the cost of improvement, COI. Now, cost of improvement includes two figures. That is, the first was during 2000-2001. That is rupees 10,000. So the first one, any expenditure, the first point I would elaborate, if any expenditure prior to 1st April 2000, 2001. Okay, prior to this date, it will be taken as nil. That value is never considered. I hope you remember these points which we discussed in the previous session. Now, second point talks about the renewal or reconstruction, which occurred in this part, in this year, 13-14, which is for rupees 4,40,000. 4,40,000. So the total cost of acquisition as well as cost of improvement, the total is this 4,10,000 and 4,40,000. Added together, it makes 8,50,000. Now, this is the total amount. What will be the capital gain tax? Capital gain will be the difference between the FVC and the total of this, that is 45 lakhs minus this 45 lakhs minus 8,50,000. So, the long-term capital gain here will be 50,000, and it will be 45 minus 8, it will be 36 lakh. So, this is the LTCG that is earned in this situation. This was a simple equation, but please remember the important thing in this equation or illustration was the dates that are to be remembered, whether it is acquisition or whether it is your improvement. We have to keep that in mind and decide accordingly. Okay. Now, this was about the equation. Now, let us move down to the next slide, that is cost of acquisition. What is cost of acquisition? Because it is very important that we understand and learn the details about it so that we can decide the amount on the basis of the date of transaction. The term cost of acquisition actually refers, as already understood by us, it refers to the amount that an assessee originally pays in order to acquire a capital asset. It is one of the most important components in the computation of capital gains because the profit on transfer is calculated after deducting its cost from the full value of consideration. So, if we talk in simple words, cost of acquisition means the original purchase price of any asset. Whenever a person purchases a capital asset such as maybe land, building, shares, jewelry, or debentures, or maybe machinery, the amount paid to obtain ownership of that asset becomes its cost of acquisition. However, the concept is not limited only to the purchase price. It also includes certain expenses of capital nature that are incurred in connection with acquiring the assets or maybe completing the ownership title. These are the expenses that help the assessee obtain legal ownership in order to improve the validity of the title over the property. For example, while purchasing a property, a person may incur expenses such as maybe stamp duty, as you are aware, registration charges, because registry has to be done, legal fees paid to advocates. They also pay brokerage or commission to brokers or commission agent. Then there are also certain expenses which prepares for preparing the documents for transfer. For example, the stamp papers, etc. Such expenses are capital in nature and they are added to the cost of acquisition because they are directly connected with acquiring the ownership rights in the asset. And this we have already discussed previously with the example also. Maybe I can go with one more example to make it more clear. That is, suppose a person purchases a house for rupees 20 lakh, suppose, and he pays 1 lakh for maybe stamp duty, and he pays 50,000 as registration fees. In addition to that, he pays 25,000 as legal charges. In this case, whatever 1 lakh 50,000, 25,000 additional, that is 1,75,000 he pays in addition to 20 lakh, which was the purchase price. This will be included because all these expenses are of rupees 1,75,000. They have been incurred to acquire that asset, to purchase that asset and establish the ownership, which are included in the cost of acquisition. So the concept becomes especially very important in computing the capital gains because a higher cost of acquisition reduces the taxable capital gain. Obviously, that minimizes the difference, and in the case of long-term capital asset, this cost may further be adjusted through the indexation part, as we have already been doing, wherever it is applicable, obviously, to account for inflation where we are doing it. So, in certain cases, the income tax also provides deemed a rule for determining the cost of acquisition. For example, assets received through inheritance or gift, bonus shares, right shares, amalgamation or demerger and conversion transaction, etc., etc. So, in such situations, the Act prescribes very specific method to determine the COA, that is cost of acquisition. Hence, we have to understand. I think it is now clear. We have to understand that why is COA is so important, because it decides your tax liability. But at the same time, there are certain situations where the COA is not very explicit. It's not very clearly given. There are certain situations where the cost of acquisition, they are to be taken up on the basis of maybe assumptions or maybe on the basis of notions, etc. So let us discuss those situations where these will be taken up as notional values. The notional values will be taken up as cost of acquisition, in fact. So what I want to express here is that in certain transactions, the assets may not be acquired through a direct purchase, maybe, or maybe actual purchase cost may not be available or relevant. As I said, maybe sometimes costs are not very explicit. So what happens in these situations? The Income Tax Act 61 provides a very special rule for determining the COA on a notional basis. That is, maybe a deemed amount is assigned then. But obviously, we have to follow certain rules and regulations, and there are certain provisions that are available which are in front of you, because these provisions always ensure proper computation of capital gains, and they prevent the difficulties that arise due to absence of the actual acquisition cost. So first, let us discuss the cases, situations one by one. First is the additional compensation in case of compulsory acquisition. When does this happen? Let us see. When a capital asset is compulsorily acquired by the government or another authority, then the assessee may initially receive compensation and they later receive additional compensation as a result of court orders or enhanced settlements. In such cases, the additional compensation that is received uh, is treated separately for capital gain purpose. Since the original cost, actually why? Because the original cost of acquisition has already been considered. While taxing the original compensation, the law provides that the cost of acquisition of such additional compensation shall be taken as nil. Therefore, the entire amount of additional compensation becomes taxable as capital gain in the year of receipt. Maybe we can go with an example. For example, suppose if the land was compulsorily acquired and compensation was enhanced later by rupees 5 lakh through a court order. Court made it mandatory that an extra 5 lakh will be paid. Then this entire 5 lakh, which is an additional compensation, it will be totally taxable because its COA is determined to be nil, is to be taken up as nil. I hope this is clear. Next is assets which are received by the shareholders on liquidation of company. Sometimes or often we find that companies go into liquidation. Then shareholders at that time, that is the point of time where the shareholders may receive money or assets from the company in exchange for surrendering their shares. So if the shareholders, now suppose they are getting those shares. Now, if the shareholders later transfer the assets received during the liquidation, then the COA of such assets will be taken as the FMV or fair market value of that asset on the date it was distributed to the shareholders. This ensures that future capital gains are computed based on the value at which the shareholders effectively acquired the assets during liquidation. For example, if a shareholders receive, suppose, land worth rupees 10 lakh during the liquidation, okay, then this rupees 10 lakh becomes the COA for the land for future capital gain computation if some transaction takes place. Okay. So this is how we deal with this. Next is the stock or shares becoming the property of taxpayers on consolidation, conversion, etc. Sometimes maybe, because of different situations or maybe need of the hour, the shares or securities, they also undergo restructuring through maybe consolidation or through conversion or through maybe division or reclassification or any similar corporate actions which leads to the restructuring of the securities, of company securities. What happens in these situations? In these situations, situations or cases, the new shares or securities, they are derived from the old shares already held by the taxpayers. Since the taxpayer has not separately purchased the new shares, the law provides that the cost of acquisition of the new asset will be treated as the cost of original shares from which the new asset is derived. This ensures continuity of taxation and avoids the duplication of cost, obviously. Maybe suppose if old shares costing rupees 2 lakhs are converted into new shares under the corporate restructuring scheme, then the cost of the new share will also be kept as rupees 2 lakh. So here what happens, the continuity is already maintained and there is no duplication of cost. Okay, they are not putting it as a maybe a new thing. So we are avoiding the duplication part also. Next, we have before us that is shares received in amalgamation. Now, in a scheme of amalgamation, that is when two or more firms they amalgamate together, then the shareholders of the amalgamating company may receive the shares of the amalgamated Indian company in exchange for their old shares. Since the shareholder does not actually purchase the new shares, the law provides continuity in cost. Therefore, what happens? The cost of acquisition of shares received in the amalgamated company shall be deemed to be the cost of acquisition of shares held in the amalgamating companies. For more clarity, I would say that cost of old shares in amalgamating company, suppose they are for rupees 1,50,000, and now new shares received in the amalgamated company of maybe equivalent amount, then obviously the COA of the new share will also be rupees 1,50,000. So it is ensuring the tax neutrality during the corporate reorganization or maybe restructuring. Coming to next, that is cost of acquisition of the shares which are received on conversion shall be that proportion of the original cost of debentures which relates to the shares acquired. So, we can say that the original investment in debentures continues as the cost basis of the shares. For example, debentures purchased for rupees 1 lakh and they are converted into shares. Then the relevant proportion of rupees 1 lakh becomes the COA of that share. I hope this is clear. It was comparatively a simpler provision. Coming to the next one, that is conversion of preference shares into equity shares. Similar to as we talked about the debenture conversion, preference shares may also be converted into equity shares. In such cases, the cost of acquisition of the resulting equity shares shall be the corresponding part of the cost of the original preference shares. This ensures continuity of investment cost after conversion. For example, preference shares purchased for rupees 80,000, later on they were converted into equity shares. So obviously rupees 80,000 or maybe the proportionate cost becomes the cost of acquisition of the equity shares. Coming to the last point, which talks about the shares or securities allotted under ESOP scheme. I've already explained ESOP. Maybe I would just say that it is what the employees, they receive shares or securities from their employer under the employment stock option plan. But since ESOP taxation rules changed over different periods, the Income Tax Act prescribes different method of determining the cost of acquisition depending on the year of allotment. So here, let us check on the years of allotment. It is the shares. First is the shares allotted. If the shares are allotted during the financial year 1999 to 2000 or on or after 1st April 2009, then the cost of acquisition will be the FMV of the securities on the date of exercise of that option. That is on the date when that option was taken up or maybe adopted. This is because FMV at exercise is generally treated as perquisite value taxable under the head salaries. Next is shares allotted before 1st April, next date to be remembered is 1st April 2007. When the shares are allotted before 1st April 2007, then the cost of acquisition will be the actual amount paid by the employee to acquire the securities. Since perquisite taxation provisions were different during this period, only the actual payment is considered as cost. Whereas shares allotted on or after 1st April 2000, not before, shares allotted on or after 1st April 2007, but before 1st April 2009. So this is a slot of 2 years between 1st April 2007 to 2009. Here the cost of acquisition will be the fair market value of the securities on the date of vesting of the options. So here we can include here further that purchase price paid to the employer or fringe benefit tax paid by the employer shall not be separately considered while computing the cost. So this rule was introduced maybe because ESOPs during this period were governed by the fringe benefit tax provisions, and therefore it is for those 2 years particularly. Okay, so this is about all these provisions that are there where the notional COA will be taken into consideration, but there are still some more where we will continue to that. That is, next is the listed equity shares or equity oriented unit acquired before 1st Feb 2018. Section 112A introduced taxation of long-term capital gain on listed equity shares, equity-oriented mutual funds, and units of business trust exceeding rupees 1 lakh. So this section deals with any of these securities that exceeds rupees 1 lakh. Earlier, such gains were exempted under Section 10, subsection 38. But since investors had acquired these assets during the exemption regime, the government introduced a grandfathering provision to protect gains accrued up to January 31st, 2018. So accordingly, where such assets were acquired before 1st Feb 2018, the COA will be determined in a very special manner. How? It takes, the CO will be the higher of any two. What two? Two figures, that is actual cost of acquisition or maybe lower of the FMV on as on 31st March 2018 and sale consideration received on transfer, whatever. Whatever is lower, it will be compared to the actual COA, and whatever is higher out of these two figures will be taken up. Okay, so point number 1 here will be compared with 2, Roman number 2 here on your slide. But the 2 will be decided on the basis of comparing A and B. Don't forget that. So it's a bit tricky, but still we have to take that into. So actually, this provision ensures that appreciation in value up to 31st January 2018 remains protected from taxation. Okay, so for example, suppose actual purchase price is rupees, suppose 100, and FFB on 1st January 2018 is 160, whereas sale price is 140. So out of the two, FMV and sale price, we take the lower value. So the lower is 140. 140 will be compared with the actual price, which is 100. Higher of the two will be taken up. So 140 will be taken up as the notional COA. So actually what we see that this mechanism, it ensures that only gains arising after 1st Feb 2018 were taxed. Next is property covered under section 56 subsection 2 para 7, 7A and 9 oblique 9. So what are these sections talking about? They say that these sections, they say that tax certain properties are received without consideration uh, or for inadequate consideration under the head income from other sources. For example, suppose gifts of immovable property, or we can say the shares received below fair market value. Or another situation can be money or property received without adequate consideration. Since such receipts are already taxed at the time of receipt, the law provides the value adopted for taxation under Section 56 should become the cost of acquisition for future capital gain purpose. For example, a property received as gift is taxed under Section 56 at rupees 20 lakh FMV. Then rupees 20 lakh will become the COA when the recipient later sells the property. This prevents double taxation at the same value of the same value. That's all. Okay. Next point is shares received in demerger. A demerger actually involves the transfer of one undertaking division of the company to another company. Shareholders of the demerged company receives share in the resulting company. So, since here the shareholders do not directly purchase any share or any new share, a special allocation rule is required, and this ensures equitable division of original investment between the old and the new shares. So, this is about the shares received in demerger. Cost of original shares after demerger. What happens here? After allocating part of the original cost to shares received in a resulting company, then what happens to the remaining portion? The remaining portion of the cost continues with the original shares held in the demerged company. This also avoids duplication of cost and ensures proper future taxation. Next is conversion of company into LLP. When a private company, or unlisted public company is converted into a limited company, then what happens? Limited liability partnership is converted into limited liability partnership, that is LLP, in compliance with Section 47, subsection 13B. Then the transfer is treated as the tax neutral, subject to fulfillment of prescribed condition. So what happens in such a case? The cost of acquisition the cost of acquisition of asset in the hands of the successor LLP shall be deemed to be the same as the COA in the hands of the predecessor's company. Hence, we can say that the continuity of cost is maintained, and it also ensures that conversion into LLP does not create artificial capital gain. It has to be actual and the correct value. Next is regarding the cost of rights of partners in LLP after the conversion. When a company converts into LLP, then the shareholders of that company, they become partners in a LLP, in that LLP. Then the cost of acquisition of rights of the partners in the LLP shall be deemed to be the cost. That is, the COA will be on the basis of the rights of the partners in that LLP. That will be deemed to be the COA of shares held in the company immediately before conversion. For example, shares in the company purchased for rupees 5 lakh, company converted into LLP, then rupees 5 lakh will obviously become the COA of partnership rights in LLP. This will maintain the continuity of investment. There is no breakage here. Then another point talks about the depreciable assets covered under Section 50. Section 50 provides a special method of computing capital gain on depreciable assets. In such cases, capital assets are not computed assets Asset-wise are not computed asset-wise but block-wise. This reflects the written down value concept used under the depreciation provision. So, whatever asset that are depreciable, they are treated accordingly. Even if the asset is held for many years, gains under Section 50 are treated as short-term capital gain because depreciation benefits have already been claimed. So, we always compute on the basis of the written down value. Then we talk about the depreciable assets of power generating units, that is Section 50A. Power generating units may claim depreciation under a different system compared to ordinary block depreciation, just to ensure proper adjustment of depreciation related benefits already available under the earlier provisions. Coming to the last point, that is undertaking which are acquired through slump sale. As already explained, it is the bulk sale or the lump sum sale. So, when it is Section 50B that handles this, when an undertaking or division is acquired through slump sale, then the undertaking itself is treated as capital asset. For the transferee, the cost of acquisition of the undertaking shall be its net worth. Net worth will generally mean aggregate value of the total assets minus liability of that undertaking. So, now whatever figure you calculate as a net worth, it becomes important for future computation of capital gains if that undertaking is subsequently transferred again or sold again. The purpose of this provision is to simplify the taxation mechanism, obviously, and the taxation of business transfers with the, involving an entire undertaking rather than individual asset. Because see, the assets are small and big in volume, maybe in nature, and it is very difficult for a company at the time of transfer to assess each individually. It is always, convenient that when we take it into as a lump sum thing, and then we continue with the transaction. I hope this is clear. So, that is all about our COA and the notional COAs that are to be taken into consideration. So, we discuss till here today in this session. We'll continue in the next. Thank you.